So basically, we're going to get a little more into the nuts and bolts of the type of transactions that businesses handle in their annual cycle. So we're going to talk about some certain concepts. The big key in accounting is something called the double entry system. Unlike your checkbook where you record your checks and then from there everything gets subtracted from cash, we have a double entry system because we don't always deal with cash. So every transaction has a minimum of 2 accounts that are affected. We're going to talk about that. And then from there we're going to understand what a trial balance is. So recognition. Recognition tells us when do we recognize a transaction. Generally speaking, we recognize a transaction when the event has occurred. But we're going to talk specifics about income and expenses as to when items are recognized. We're also going to understand how we value those transactions. Monetarily, what do we assign to specific transactions? And then we're going to talk about what account do we put them to? How do we classify the various transactions we're dealing with? So we talked about in Chapter 1 that transactions, business transactions, are economic events. Every economic event is going to change the financial condition of a company. They're going to always transfer or change the condition of a company. I don't want to restart now. I want to postpone that. And so business transactions that affect the financial position of a company need to be recorded in the books because something has changed within that company. We're going to talk about some real specifics there. So here is a great visual of understanding when you have an economic event, if that economic event you can recognize, you can value, and you can classify, then it's going to be a business transaction. Remember when I say to Melissa, Melissa, I want to hire you to work this year. Okay? That was an economic event. But can we recognize anything? What happened? Nothing. Can we value anything with, Melissa, I want you to work for me this year? Was any value placed or in exchange? No. Can we classify anything? No. So it wasn't a business transaction per se because there was not a change in value, a classification, or any type of recognition. But if I say, Melissa, I really want you to work for me this year. I want to secure your spot, and I'm going to give you a $1,000 signing bonus so you will hold yourself to work for me this year. Okay? That was the event. Can we recognize that? What is it we're recognizing? Today, I gave her a check. We recognize today's the day. What's the value? $1,000. And we would have to talk about how are we going to classify that. At some level, I might put that as a salary or a pre-signing bonus. I would record it in some manner because we can show that there was recognition today when it was recognized. We experienced that event today. The valuation was $1,000 and the classification is some sort of salary or an employee sign-on bonus. Does that make sense? As a result of that, then it's a business transaction that needs to get recorded because what's happened here? I have $1,000 of an expense as a result of signing Melissa on. My cash has been reduced to $1,000, hasn't it?
But in other cases, an economic event would be after they work for 2 weeks and then they get their first paycheck?
Absolutely. Absolutely. Actually, not necessarily even after they get their first paycheck. After they work 2 weeks, before I even give a paycheck, I have an expense because that's transpired, and I have a payable on my books to show I owe them. Then once I pay the payroll, I get to reduce my payable, and I'll reduce my cash because I forked out the money. Exactly. Until something occurs, we really don't have a business event that we need to record. But you're exactly right. Once those 2 weeks are up and I have payroll, even though I didn't pay it, I owe them money, don't I? The liability is there. Recognition refers to the decision as to when we record a transaction. Really important. Recognition relates to when. Companies set up specific recognition policies, such as recognizing revenue when title to goods passes or a service is provided. So, for example, when Troy comes to me and says, Nancy, I want you to do my taxes this year. Is there anything I can recognize? No, he just said he wants me to do his taxes this year. Troy comes to me, and a week later I complete his tax return. Can I record revenue then? Even though he hasn't paid me, did I complete the job? So many companies have criteria in place, and we have generally accepted accounting principles that help us determine when you recognize a transaction. Let's just say Troy has an audit with the IRS. He wants me to represent him, and he gives me $1,000. Now, I would recognize that he gave me that $1,000, but it's really not income to me. My cash increases, but I really have a liability because I haven't done the work. It's not until after I complete the work that I can show income. And don't worry about that, but know we're going to have criteria as to when can we show income. When do we report expenses? So, generally speaking, most companies have it spelled out when things do get recorded. Recognizing revenue. Okay, here's another example. Let's say I purchase a couch from the Dayton's in here anymore, the Macy's home store. So I order a couch. Do you think Macy's shows that income right away when I order it? Probably not. Not until it's being delivered to me. When the title of that couch transfers ownership from Macy's over to me, can you recognize income? We're going to get into all those specifics, but no, we'll be able to determine when we recognize things. Okay? Next, we have, with recognition, deciding when to record a transaction is important because the date on which a transaction is recorded affects the amounts in the financial statement. It's December 31st. I completed a tax return. Do I record that tax return on December 31st? Or do I wait and record it on January 1st when Troy comes in with his check? See the difference? Difference in a year. Do I record it in 1 year or do I record it in the next? Or I go to Best Buy and spend $10,000 in computer equipment on December 31st. Do I record that transaction when I bought the goods, took them out of the store, gave them my credit card? Or do I wait until January when I pay my bill? I record them on December 31st. I received the goods and I have a debt to pay. Even though I haven't paid it yet, it's a liability. Does it make sense? Kinda? Valuation is how much. Valuation is the process of assigning money, a monetary amount, to the business transaction and resulting assets and liabilities. Now, generally accepted accounting principles state that all business transactions should be valued at their fair value, which is the exchange price of an actual or potential business transaction between market participants. You know, I really like Troy, and I'm doing his business taxes. I said, Troy, I really like you. I'm going to charge you $150. So he writes me a check for $150. What does Troy record as the expense for his business for getting his taxes done? What? 1,000. 150. But Troy, you know it was worth 1,000. I just liked you. And you want to record 1,000, Kenny? No. The fair value we really exchanged is what he has to record. Guys, this happens a lot with me with clients. They will do some work. And let's say they are finishing their home and they sold their home. And so we're trying to figure out what we call the basis on their home. You know, what they purchased it for plus all the improvements they put into it. So I'll say, well, how many dollars worth did your receipts total? Well, 5. But I did all the work myself and it really would be worth 50. But what do you have receipts for? 5. But can't we value my time? Did you pay someone that you have a receipt to show? Then you could. But your own time, you can't show me. Does that make sense? So, valuation.
They can pay themselves. You know, write a check, say from, they, for example, 2 checking accounts. So if John did the work himself in John's home, he could write it to his wife and labor.
But then his wife would have to claim it as income.
Correct.
Correct.
It all depends. You know, what the piece. So,
but you're
anything, but you're showing the
exactly.
valuation.
So basically, we really need to show things at fair value, what really happened. Not what you might have paid, what did you pay. Does that make sense, guys? Okay. Now, recording transactions at the exchange price at the point of recognition is called the cost principle. What did it really cost is what we really take. Not what you would have paid if you didn't get a deal, but what can you prove? Okay? At the end of the day, it's all going to be about what you can substantiate. If you wrote a check for $50 and you have the receipt for $50, then it's $50. Yeah, you might have gone to another place and had to pay $200, but you didn't. So the cost principle is we value everything at cost, the true value that you had to pay for it or that you received for it. It's pretty logical. There are no benefits here. It's just we're doing true transactions based on what really happened. Classification, assigning transactions to various categories or accounts. Basically, in this chapter, we're going to start talking about what's an expense and what's an asset. Now, I gave you a little hint on what an expense is. The expense is part of the income statement. And usually every expense account has the word expense in it. An asset is on the balance sheet. And assets are resources that will provide future benefits. They are such as cash, buildings, equipment, accounts receivable, things that will give us a future benefit. Proper classification depends not only on correctly analyzing the effect of each transaction, but also on maintaining a system of accounts that reflect that effect. So here we're going to do a little bit of problem solving. 3 major issues underline every accounting transaction: recognition, valuation, and classification. So we're going to take the terms recognition, valuation, classification, and match them to these 3. Number 1, records a piece of equipment at the price paid for it. What?
Valuation.
Valuation. How much? Number 2, records the purchase of the equipment on the day on which it takes ownership. Number 3, records the equipment as an asset because it will benefit future periods. Does that make sense? The when, the how much, and basically the where to record. What place do we record it? The what maybe is a better way of saying it. Now, we're going to talk about analyzing transactions and preparing a trial balance. In doing this, in analyzing transactions, we're going to use a system called the double entry system. Because in doing this, we are going to take each transaction and we're going to have one debit, minimum of one debit account and one credit account for everything we do. The debits ultimately always have to equal the credits. The most important thing when we deal with a debit and a credit is what is a debit and what is a credit. We're going to talk about that. So, when we have these various accounts, which is like our little storage place for storing transactions, we have this account that we put information in based on various accounting data. And these accounts accumulate the same type of transactions. So, for example, we have assets, we have liabilities. What happened there? And